the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market ended the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements. Well, Singapore shares rallied today alongside its regional peers in Asia. The Straits Times Index was up 1.02% at 3,833 points at about 12:20 p.m. Singapore time. We're looking at a value turnover of some 731 million Sing dollars in the broader market then. Now let's take you through the closing numbers. The STI ended close to 1% in a green, up 0.97%, up 0.97% at 3,832 points. In terms of value turnover, we are looking at 1.68 billion Sing dollars. Now gainers outnumbered losers, 385 versus 178. Top advances for today we've got for you DBS, UOB and Venture Core. And top decliners we have GMHUSD, ST Engineering and Multicam. Now in terms of counters to watch, we have Keppel Reit because the Reit manager reported today a net property income growth of 13.3% year-on-year to 54.6 million Sing dollars in Q1 of 2025. In the meantime, developments in the US remain in focus given a change in stance or narrative by the Trump administration on the Federal Reserve and on trade with China. Now that's as US President Donald Trump said overnight that he had no intention of firing Fed Chair Jerome Powell while signaling a more conciliatory approach to the trade war with China. Now, lots going on in global markets, and let's break them down with Thilan Wickramasinghe, Head of Equity Research at Maybank Securities. Thilan, welcome.
Thanks for having me on the show.
Great to have you back, and lots going on globally, Thilan. And let's start with the US this time around. There appears to be a change in, call it narrative or stance, by the Trump administration when it comes down to the Fed and when it comes down to the trade war with China. Now, investors appear to welcome the news with open arms, markets higher right here in Asia. But really, how would you read into this, and how far can the new comments by Trump be relied upon, really?
Tread carefully. I think that should be the default operating advice in these markets. I think the genie that President Trump unleashed from the Rose Garden 3 weeks ago is going to be very hard to put back into the bottle. We have policy changing at the speed of a tweet from the White House, and it's continuing to add volatility to the market. So while the comments about the Fed chair as well as China tariffs are positive, there is no guarantee that the status quo for this will prevail tomorrow or even a week from now. So I think investors need to be cautious in taking short-term trading positions. We are already seeing trading volumes turning weaker, so there is caution already prevailing in the markets, and I think that's going to continue.
If I can zoom in on US-China trade, right, Thilan, how far do you think the U.S. will have to stick with its current narrative on a more conciliatory approach? And how far do you think China will bite given Trump's on-off policy? Any guesses as to what that middle ground that both sides could reach will be, and what would that mean for U.S. and Chinese equities?
Look, I mean, during the first Trump term, it took 2 years of negotiations to come up with a deal. And this time around, talks haven't even started yet. Remember, the tariffs are not as the tariffs, the first time was not as extensive or as complicated. So getting a deal this time around will take time. So of course, the flip side is that President Trump may not be able to afford to keep China on very high tariff levels, as that might actually drive U.S. stagflation. This will have an impact. Clearly on its popularity rating as well, and it's already low. So we think the U.S. will come up with some measures to ease the tariff pressures on China. So that will be a positive signal for stocks. I mean, we are starting to see even just the news flow of tariffs easing is positive. But I think the overall direction that the U.S. wants is still to kind of have tariffs in place to reduce that trade balance. So I think that will be something that we'll have to continue to watch.
Do you think that, based on what you mentioned at the start of this interview, threat with caution, and also, what you said about U.S. tariffs in the longer term, How far do you think the current optimism we see is going to be short-lived?
We are seeing that the policy keeps changing every day, and sometimes the policy flip-flops within the same day. So I think, markets are looking for signs for bottom fish. Markets are looking for some optimism. But if you look at the past few cycles, global financial crisis, or the 2000-2001 recession, we did see months, bear market rallies, 4 to 5 bear market rallies before the market fully bottomed out. So I think that's probably something that we are kind of seeing as well, given the fact that we really don't have any sort of policy certainty at this stage.
I know we talked a lot about uncertainty into the longer term, but for now, Thilan, the International Monetary Fund, the IMF, said that worldwide economic output will slow in the months ahead, given how U.S. tariffs on virtually all trading partners are beginning to bite. IMF projects global growth in 2025 to slow to 2.8%, the poorest showing since the COVID-19 pandemic, and that is down from 3.3% in 2024. How far are you aligned with the numbers, given the change in stance by the Trump administration, or will economic output globally continue to slow regardless of what the U.S. says? Because countries are looking to diversify away from the U.S., they are perhaps looking to even do so at the cost of sacrificing growth.
Yeah, so I think the damage has been done with the tariff rollout. So more and more countries and businesses will be considering reshaping their own supply chains and also building alliances outside the United States. Now, this will involve a period of reassessment. So you will see activity falling until governments as well as companies really try to figure out what is happening and how they are going to be placed in terms of strategy. CapEx will be put on hold, hiring will be delayed. I think new product launches may actually get pushed back as well. We saw that with Nintendo recently. So in this context, the cuts to global growth by the IMF is not really surprising. We actually think that the risk could be on the downside even more. Our own house view, we expect global growth to come in at around 2.5% for 2025, which is actually below IMF's new forecast. One exception, though, is that we expect our region, ASEAN, to fare somewhat better with growth coming at around 4.2%.
Okay. And back home right here in Singapore, Thilan, it is nomination day for Singapore's general election 2025. And Singapore also released its latest inflation print for March. So going back to the Singapore stock market as usual, how would you assess the STI's movements today? More driven by international developments versus what's going on at home? Any surprises there?
Yeah, I think the STI is responding more to global cues. Historically, there's been very little market correlation between election outcomes. If you actually go back and look at the past 5 GE cycles, the STI was flat to slightly negative 80% of the time, 3 months after an election. Now, having said that, expectations of fiscal stimulus, especially amidst all this global uncertainty later this year, could actually have positive impact, particularly in sectors like consumer, Reit, and some of the construction names as well. Now, in terms of big movers today, we did see the banks gaining, with DBS leading by about 2.5% gain. I think these stocks are seen as safe havens, and there has been active share buybacks by the banks themselves as well, so that's been supporting the share prices. We also saw the REITs coming back a little bit more, especially MLT was up about 3.5%. I think there's better sentiment coming back to that sector, especially with Singapore's base interest rates falling. On the negative side, we saw ST Engineering and Singtel being sold down. They both hit 52-week highs yesterday, so I think, and they've been pretty solid performers as defensive plays. So I think that investors are taking some money off the table from these counters.
Thilan, you talked about S-REITs in particular. We've seen a number of them report their earnings and business updates, among them Keppel Reit as well. The manager reporting today a net property income growth of 13.3% year-on-year to 54.6 million Sing dollars in Q1 of 2025. How would you read into Keppel Reit's latest performance, and how far is the latest result an indication of what earnings could look like for the other S-REITs reporting in the coming days?
So on K-REIT, it was a fairly mixed quarter. Some of the weakness was expected. For example, we expected higher financing costs to be offsetting some of their top-line growth. Some of the occupancy decline has also been pretty well flagged before. On a positive note, we saw backfilling of most of their vacant space happening pretty quickly and at higher rent, so that's quite good. On a slightly negative note, the debt cost guidance remains unchanged from the last quarter, despite base interest rates actually coming down quite a bit across different currencies. So that's something to watch out for. Now, in terms of the overall REIT sector, we've had about 5 REITs reporting so far: Sabana, KDC, ESR, Logos, P-REIT, K-REIT. Other than K-REIT, we saw bottom line distributions actually growing year on year for the rest of them. Internal operations have been mixed. We saw KDC, K-REIT, ESR seeing some occupancy declines, and P-REIT was actually more supported by their master leases. Overall, broad operations appear a bit soft, and none of the management teams are really talking up about interest savings yet, despite the steep decline in interest rates. So we're expecting the rest of the REITs also to report along similar lines.
Okay, now if you're just tuning in, we're now in conversation with Thilan Wickramasinghe, Head of Equity Research at Maybank Securities. Thilan, further away, Intel has reportedly poised to announce plans this week to cut more than 20% of its staff, aiming to eliminate bureaucracy at the struggling chip maker. And that is apparently according to a source familiar with the matter, who also noted that the move is part of a bid to not only streamline operations and management, but also to rebuild this engineering-driven culture. This, if it turns out to be true, it would be the first major restructuring under the new CEO, Tan Lip Bu. What do you make of the move, and can the new CEO restore Intel to its former glory?
I think it's too early to say whether Intel will return to its former glory. The new CEO has been on board for just a month. But he does bring a venture capitalist perspective, focusing on strategic investments and partnerships. He has emphasized on restructuring and streamlining operations to enhance efficiency, and also seems to be aiming to revitalize Intel's competitiveness in the semiconductor side. So all of this is positive, and he is signaling that he's serious about aggressive restructuring. But we will need to see how execution pans out, and that's actually the most important part, not just the plan. Now, on what some of the things that we're looking for in the results is on guidance on how much more job cuts can we expect. We've had job cuts now for 2 years in a row. And I think that's going to be something that investors really will be focusing on, particularly from the point of view of how is that going to impact innovation.
And speaking of tech earnings, Thilan, and also tech firms in the US, we were talking about Tesla on the show yesterday ahead of its earnings release, and now we've got the numbers. Tesla, that EV maker, reporting a 71% drop in first quarter profits. It also retreated from its 2025 guidance, citing unpredictability over trade policy and also demand. How would you assess the latest numbers?
Tesla's revenues were below analyst expectations. We saw the auto and energy market uncertainty playing a big part in these results, and this has also made future guidance harder. There was also concern that the tariffs could actually increase the price of lower-end Teslas by around $5,000 and the higher-end ones around $10,000 to $15,000. Now, with Trump pausing tariffs, there may be some breathing space, but Tesla has been losing out to lower-cost competitors for a while now. The new affordable vehicle that they announced, that's quite promising, but that won't reflect on their second quarter numbers. So how well this new line performs will actually matter a lot for the performance of the rest of the year. Now, a positive is that Elon Musk has reassured investors that he will be recommitting to Tesla and his work with the U.S. government is coming to an end. So that's something positive to watch out for, because a refocused Elon and a renewed brand building is something that investors should be paying some attention to with Tesla.
I see. Thanks so much for the insights as always, Thilan. That was Thilan Wickramasinghe, Head of Equity Research at Maybank Securities. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.